Alrighty. So in this video, I'm going to be sharing with you what I call the ultimate bull put spread trading strategy. Now, first of all, what you need to understand is that there are many different ways to put on the bull put spread. So there is not just one way to be profitable. There are many different ways to be profitable when putting on this trading strategy. So this is something that you need to understand. I'm just going to be sharing with you my version because it has been doing very well for me. Alright. So first of all, what is the bull put spread? So the bull put spread is a bullish credit spread, also known as the short put spread. It is a bullish option trading strategy where your risk is defined, right? So it consists of two single options, right? Two single put options. So the first off, you have the short put option, which I like to put it somewhere out of the money, right? Some people like to put it at the money, or some people like to put it in the money, right? So these are three different ways that you can do it, but generally I like to do it out of the money. So this way you have a higher probability of winning, because let's say, for example, if the market is here and let's say by expiration the market actually settles somewhere down here, right? It is below the initial price when you first initiated the bull put spread, but then it is above your short strike. So as long as it is above your short strike by expiration, you will receive the full credit. You'll make the full amount which you have received when you first place on the trade. But if you put on the at the money bull put spread, let's say for example your short strike is here, then guess what? You're going to be in a loss at expiration if it closes below your short put strike. So that is the reason why I like to be placing this bull put spread, the short put strike, out of the money. Now the next thing what you want to understand is that your risk is defined to the width of the spread minus the credit received. So for example, if you have a 5-point wide spread, so let's say for example you have the 195 bull put spread on, so this is a 5-point wide spread. So the risk, the maximum risk will be $5 minus off the credit which you receive, which is $1.50, and this gives you a maximum risk of $3.50, which is equals to $350 per contract, right? Per contract, per spread. So this is very important to understand because you need to know how to position size your trade accordingly. I've got a lot of questions from people saying that, you know, how many contracts should they put on each time when they put on one of this bull put spread? So the answer really comes down to your account size and how much you're willing to risk per trade. So let's say for example you have an account size of $10,000, right? So you have an account size of $10,000. This is where you need to decide what is your risk you want to put on. So generally you want to risk anywhere from 1% to 5% per trade, right, on your account. So in this case, let's say for example the maximum risk is $3.50, which is $350 per contract. That means you can only risk 3.5% to 5%, right? So your range will be from 3.5% to 5% per trade, right? So if you have a bigger account, let's say for example you have a $100,000 account, then you're able to risk a smaller amount because you have a bigger size and you have more room to play with. So for example, if you want to risk 1% on a $100,000 account, that means your maximum risk would be $1,000 per trade. So $1,000 per trade, that means you can put roughly 2 to 3 contracts of this bull put spread. So you put on 2 to 3, so that means each time you'll be receiving roughly $300 to $450 per trade. So this is very important to really understand because this is how you position size. I've got a lot of questions, people asking me this. So this is pretty much how you calculate your risk. So first off, identify your account size, you know your account size, and then identify what is the maximum risk you want to put on per trade. Now the next question you might be asking yourself is, if whenever you make money, right, you're only making $1.50 in credit, but then you're losing $3.50, wouldn't that mean that one loss would wipe out 2 wins? And the answer is yes. So the question is, how do you actually be profitable in the long run, right? If you're going to be losing so much more than you're going to be making, right? How are you going to be profitable in the long run? And the answer is to have what you call a positive expectancy, right? So in this case, for you to have a positive expectancy, because your wins is generally lesser than your losses, you need to have a high win rate, right? So what is positive expectancy? So if on average, let's say for example you're making $1.50 when you win and you're losing $3.50 when you lose, then to have a positive expectancy in the long run, you need to win more than 70% of the time. So if you're not familiar with the term expectancy, basically it's a way for you to calculate, whether you're going to be, whether this trading strategy is going to be profitable in the long run, or is it going to be a loser in the long run. So how you calculate it is pretty simple, right? So first off, you need to identify what is your win rate, and then you times the profit that you make whenever you win minus off the loss rate times the loss. So this will give you an expectancy number. So that is to tell you whether you are going to be profitable in the long run. Now, of course, you need to have a large sample size. You need to have a sample size of at least 100 trades or more to have a rough gauge of what your exact win rate is when you win and your loss rate is, right? So to have a positive expectancy, first off, right, you need to have at least 71%, because if you see it this way, if you have a 71% win rate and you win $1.50 each time you win, and then your loss rate is 29%, you lose $3.50 each time you lose, you're going to have a positive expectancy of 5 cents, which means to say you're going to have an average of $5 profit per trade. So if you're going to have 100 trades, then that's going to be $500. If you're going to have 1,000 trades, that's going to be $5,000. So that's the beauty of positive expectancy. If you have a positive expectancy trading strategy, then you know that you just need more trades to make more money. All right, so now you understand how to be profitable in the long run. You have this positive expectancy understanding. The big question is, how do you actually put the odds in your favor to ensure a positive expectancy? How do you ensure that you at least win 71% of the time, right? So the answer comes down to 3 key criteria to put the odds in our favor, right? So my strategy relies on these 3 key criteria. And the first criteria of which is to use what I call the stochastic oscillator to identify when the market is oversold, right? So you want to wait until the market is oversold. Now you can use either the stochastic oscillator or the RSI indicators. Basically, these are just 2 indicators to identify the market condition, whether it's overbought or oversold, right? If you're not familiar about these 2 indicators, just go ahead and just Google it. Right, you'll find a lot of articles on this. Now, if you want to know the settings which I use for my stochastic oscillator, right, I already created a video on this. You can go ahead and click the link at the top right hand corner of this video, so you can watch that video first to find out how I use the stochastic oscillator. Now, the reason why I want to wait until the market is oversold is because there is a higher probability of a bounce when the market is in an oversold condition compared to when it is overbought or when it's a neutral condition. Now, if you've seen these indicators before, right, for example, the stochastic oscillator, you notice that there are these 2 lines, right? There's this 80 and there's this 20, but basically these are readings to tell you when it's overbought. So 80, anything above 80 is overbought, anything below 20 is oversold. Anything in the middle is considered rather neutral, right? So you want to wait for this line to go below 20 before you start looking for bull put spread trade setups, right? So when it comes to putting on a bullish trade, there's only 3 different conditions that you can put it on: when it's oversold, when it's overbought, and when it's somewhere in the middle, right? So if you were given 3 choices, right, to put on a bullish trade, would you rather put it on when the market is overbought, where the market has already gone up so high, or when it's neutral, somewhere in the middle, or when it's already oversold, right? Chances are the smarter way would be to put on this bullish trade, the bull put spread, when it's oversold. Now, there'll be times when you put on the bull put spread when the market is oversold, and then the market still continues to sell off. That happens in trading. There are no guarantees that once it's oversold, the market will definitely bounce back up. Right, so it is a probability game. The key here to understand is that there is a higher probability of it bouncing back up when the market is oversold compared to when the market is somewhere neutral or when it is overbought. Right, so this is key criteria number 1. Now, key criteria number 2 is to place the bull put spread below a support level. So generally, this is where you have seen evidence where the price have bounced back up before, or it could be just a previous low. Right, for example, you may have seen a few times where the price have bounced back up, right? So this is what you call a support level. Or it could be when the market has gone down, and then at this point you notice this is a previous low. So there is another chance that if the market was to go down here again, it could test this level and then bounce back up. So this is why you want to always identify a support level. You could also identify a dynamic support level, and that is using moving average. So for example, if the market is in an uptrend, let's say the market is in an uptrend, and then there is a moving average, right, which you use, and you notice that the market has actually bounced off this moving average, let's say several times. Let's say for example it's bounced up each time it touched this moving average. Then this moving average at this point down here can also be considered a dynamic support level, where you can choose to place one of your bull put spread. You can choose to put the short strike of the bull put spread below this moving average. So this can also serve as a support level. So you have one where it is by price, the other is by the moving average. So by placing the bull put spread below a support level, it decreases the chances of the market breaching the short leg of the bull put spread. So that's key criteria number 2. Now key criteria number 3 is to identify the delta of the bull put spread, or rather the short strike of the bull put spread. So the short leg of the bull put spread, ideally you want it around 20 to 30 deltas. Now, while the definition of the delta is the theoretical estimate of how much an option's value may change given a $1 move up or down in the underlying security, it can also be used as a rough estimate on the probability of profit. So for example, if the short strike is a 30 delta, so that means it will be roughly a 70% probability of profit. So that's how you define your win rate in this case, right? So we have already delta working for you. This is using complex mathematical formula to derive this probability of profit. So just by the delta alone, you're really going to have a rough gauge of the probability of the profit, right? So imagine if you were to include key criteria number 2 and 1 into the mix as well. This is going to give you an even higher chance of you succeeding in this trading strategy. So that is why we want to have these 3 key criteria present when you put on the bull put spread. Alright, so ideally we do not want to go lesser than 20 delta, because then you won't be able to get enough premium for the risk we're taking on the spread. So remember, this is like a give and take, right? So you may have a higher probability of profit through the delta, right? You can choose very low delta and have a very high win rate, but the problem is that your premium is just going to be too little. So this means that you may even need to win even more time for you to be able to profit, to get a positive expectancy in the long run. Alright, so now that we know the 3 key criteria, let's get into the steps to put on this bull put spread. Alright, so there are 7 steps. I'm just going to go through this very quickly. Step number 1 is to wait till the stochastic oscillator is showing an oversold condition. Next is to identify the previous support level, and then we go to the option chain and look for the options that's around 30 to 60 days to expiration. This is my favorite time frame to put the bull put spread on. Right, and then you want to find a strike that is below the previous support level, and then see if the strike is within 20 to 30 delta. Right, if it's not, then you want to wait until the market goes lower, becomes more oversold. And then if the strike is within 20 to 30 delta, this is where you want to construct your bull put spread and see if you can get at least $1 to $1.50 in terms of premium for a 5-point wide spread, or at least $2 to $3 in terms of premium for a 10-point wide spread. So finally, if you're satisfied with the premium received, place a trade, and then we'll manage the trade accordingly. Alright, so we're going to get into the trade examples. So we're going to know exactly how to put these 7 steps into action. By the way guys, if you find this video helpful so far, I'd appreciate if you hit the thumbs up button, and also please subscribe to my channel so I can create more videos like this for you in the future. Okay, back to the video. Alright, so here is the first example. This is of Apple. So if you can take a look down here, you can see that the market has come down quite a bit from the highs of this point, and at this point you can see that the first step we want to look out for is to see if the oscillator is oversold. So in this case, you can see the market is oversold. Next, we want to identify a previous support level. So we can see there is a support level down here. The price is around 129. So what we want ideally is to have a short strike that is below 129. So what we want to do next is to go and take a look at the option chain. You want to pull up the option chain so we can see that the nearest strike that we can get that is below the previous support level is at 125. So what you want to do now is take a look at the delta. So now the delta is 33 deltas. So that is slightly above our 20 to 30 deltas, but that is fine as well because it is below the previous support level, and then it's at 125, right? So it is quite a bit away below the previous support price level down here. So the next thing what we want to do is to try and construct it to see whether we can get the right premium. So let's say, for example, if we take the 125 and the 120 bull put spread, so you can see from here the credit which we're going to receive is $1.37. And remember, we want to get roughly around $1 to $1.50. So this meets our criteria and we can go ahead with this bull put spread. Now, what if you wanted to have a higher probability win rate, right? You want to have a higher win rate. So let's say you want to go for 120,115. So 120,115, you can see it's somewhere down here. So it will be even harder for the price to breach to 120. You have to go much further in order for us to lose this trade. So you want to take a look at the credit. Are we able to get the credit which we want? And from here you can see the credit which we receive will be $3.30, right? We take the mark, 330 minus 227, we get $1.03. So this is possible as well. So in this case, we have two choices. You can either go for the one that is 125, 120, or you can be a little bit more conservative and then you go for the further away strike at 120, which you will get $1.03 in terms of credit. Alright, let's take a look at example number 2. This is IWM, which is the Russell 2000 ETF. So at this point in time, you can see on the right hand corner, we have an oversold condition. It has been oversold for some time already, ever since probably somewhere down here. But you notice at this point, there's no way you're going to put on a bull put spread because according to our criteria, we need to find the strike that is below our previous support level. So you can see down here, the support level is here. Now, if you're aggressive, you may want to choose this one. Alright, you could go for it, but I like to find one where, you know, there is a clear support level. So I like to choose this one down here. So ideally what we want to go for is for a strike that is below 162.48. So the next thing we do is pull out our option chain and see what we can get, right? So 162.48, so it seems the closest we can get is actually 162. This is just right at a support level, below it by 48 cents. So the next thing you want to do is you want to try and construct it to see whether we are able to get the right credit. So if we were to construct this, you can see that the credit which we're going to receive, all right, for 160, all right, so in this case I actually use the 160 first. So 160 and the 155, so that is somewhere below down here. So you can see for 160,155, the credit which you receive is around 72 cents. So that is way below what we want. We want anywhere from $1 to $1.50. So nope, we cannot use this. So we may have to get a little bit more aggressive. We want to see whether we can get the right credit at 162. So let's take a look at 162. So we take 162 and 157. Again, this is a 5-point wide spread. And we can see that the credit which we're going to receive is only 84 cents. So again, this is not going to meet our criteria and I would not be looking to put this trade on. So what we want is for the market to go down a little bit further. So once he has gone down further, then we take a look at the option chain again and to see if we can construct a bull put spread with the credit which we want. If we can, then we'll put on the trade. But if we cannot, again, we just sit on our hands. Alright, example number 3. So example number 3 is CRM. So let's say, for example, you pull out the chart and then you see that the market has been going down a lot and the market is oversold. So we have the first criteria met. Now, what if you were to look at the past, the past prices? You take a look at the past price and you see that there is no support level that is below our current price, right? You can see that the support level is down here. It has already been breached. There's another support level down here that has also already been breached. So what do you do? Right, so in this case, what you can do is you actually pull out to the weekly chart. So instead of staying at the daily, you go to the weekly and you try and find and see whether there is a previous support level. So by pulling out to the weekly chart, you can see that many months ago, there is actually a support level down here. In fact, if you were to find support levels on a weekly chart, it can actually be much more powerful than support levels on the daily chart. Right, so on the weekly chart, you can see that it is 115.76. So what we want to do ideally is we want to find a short strike of the bull put spread below this price down here. So again, what we do is we put up the option chain to take a look and see whether we can get the credit which we want. So the one which we can actually go for is 115, right? We have a 115, which is just below this. So what we want to do is construct a bull put spread to see whether we can actually get the credit which we want. And in this case, unfortunately, we aren't able to get the credit which we want. So what we're going to do is we are just going to wait, sit on our hands and wait for the market to go a little bit lower. Once it goes lower, then we can get the right credit, then we will put on the trade. Alright guys, so that's it for this video. I hope that you found this video helpful. If it has, I appreciate if you give me a thumbs up and also subscribe to my channel as well. This way I can create much more videos for you. And as always, thank you for watching. I appreciate your time and may the options favor you.